What is going on, guys? Nick here, back with another video. If you've been watching my videos, I hope that you learned by now that I'm not really interested in any weird speculation or crazy trading strategy. My goal is basically making the most money possible long-term on the stock market. And with these videos, that's the exact goal that I'm trying to teach new investors who are watching. As a new investor, my path was pretty typical to the same path that most new investors take today. You go on the internet, you start researching, you see random companies that people are talking about, and you don't know anything about them, and you just start buying and hoping that this price is going to go up 50%. So in this video, I'm going to give you my 3 best tips for how to decrease the learning curve up front and how to get on a path to making actual money in the stock market long term. So my first tip for all my new investors is to stop buying risky stocks. There is no shortage of new investors who are out there looking to double their money every single month. So they basically take all of their money, they put it into a penny stock that they don't know anything about, and when the price goes down 70%, they have no idea why. Doubling your money month to month or hitting home runs constantly is completely impossible. If you started investing with just $1 and you doubled your money every single month, after 2 years and 5 months, you'd be worth more than Jeff Bezos. After 2 years and 7 months, you'd be worth more than $1 trillion. And since we haven't seen any trillionaires on Earth yet, I think a lot of these people who make these crazy claims about their insane returns that they get aren't really feeding you the most accurate information about their total returns, and there's no way that they're able to consistently pull off these gains long term. While a lot of the stocks that they promote have great potential for return, the probability of success is extremely small. So let's say, for example, you had 10 stocks and they could either go up 500% or they could go down 50%. Let's say the chance of succeeding with this is 10%, meaning the chance you don't succeed is 90%. When you do the math and you factor in the losses that these stocks would end up taking, you only end up with a 5% return. And I think that the problem that a lot of new investors have is they don't really understand how much losing money actually sets you back. When you lose 50% on a stock, that actually means that you have to make 50% on another stock just to get back even to where you were. And also with most of these risky stocks, they're very hard to forecast how things are going to go for them in the future. Most of the underlying financials with these companies are junk, meaning they're losing a ton of money on their income statement, they've got a ton of debt on their balance sheet, and the only real value in this company is speculation that some singular product is going to work out and this company's value is going to go through the roof. I find that biotechs are extremely dangerous for this because for normal people like you and me, it's almost impossible for us to do product research on the things that they're developing, and most of the time, you're only betting on getting FDA approval for one specific drug, and as soon as they fail approval for one of their tests, the stock price will plummet 50% overnight and you'll have no chance of getting ahead of this. Also, because I just thought of one more tip while I was recording this video, stick around to the end. I'm going to give you guys a bonus tip that's really going to help you out. Tip number 2, learn how to buy long term. The easiest way to make money as a brand new investor when you still don't really know what you're doing is to just buy the best companies out there and let their share price do all the work for you. If you were to take a snapshot of Apple, Amazon, and Disney's share price today and look at where their share price is 5 years from now, I can almost guarantee you'll have made a ton of money. And while buying these companies isn't necessarily going to guarantee you a home run every single month, you're going to hit a lot of singles that are going to add up to a whole lot of points, and over a couple years you end up with a whole lot of money. September 6th of 2016, I bought my very first share of Apple at $107.59. And I think that week I was actually a little disappointed with my purchase because I'm pretty sure the price went down a little bit. I remember thinking, oh man, I could have got it at $105. Well, today the share price closed at $385. So over that time period, I've made 250% return. This works out to a 37% per year average, and this number also isn't including all the dividends that it paid me over that time period. So you might be wondering then, how do I figure out if a company is a good company and it's going to increase its share price over time? So I would say that there is 2 very important factors. They're not the only factors, but the most important ones to determining whether or not a company is going to continue to grow its share price over time. The first one is increasing revenue and net income. Sometimes people only look at the earnings per share to determine whether or not a company is growing, but the problem is companies buy back their shares over time, and because of this they can increase their earnings per share without actually increasing their profits. If the company ever has to stop doing buybacks, you're going to end up capping a lot of your growth. I find that sometimes net income isn't always the easiest thing to track growth of over time because it tends to be more volatile. So generally what I'll do is I'll look at revenue growth over time, and then I'll look at net income growth over time, and I'll kind of compare the two to get an idea of how much growth this company is actually realizing. The second major thing that I want to see is a company in a manageable debt situation. My favorite metric to determine a company's debt situation is comparing their debt levels to their equity. Generally, I want to see debt at less than half of equity, but sometimes debt can get up to about equal with equity or maybe slightly higher, and that's okay too, as long as the company has good growth prospects long term and is very stable. When you start to see companies get their debt levels of 3 to 4 times equity, that's when you start seeing serious problems and really have to be concerned about the company's future. I would generally recommend avoiding companies with high levels of debt for long-term investments. The next tip is, if you like this kind of content and you want to see more of it, scroll down and hit the like button. It really helps out the video and it lets me know that I need to keep making videos like this to help you learn how to invest. Okay, and the last tip that I have is to practice with small amounts of money. While I have 95% of my portfolio in long-term investments, I still keep 5% aside to practice and to try experimental investment styles. You don't have to use a lot of money to try out new things. You can just buy 1 or 2 shares and see how something goes. You know, personally, one time I tried using a stock screener to find the smallest, best company I could and invest and see what happens with it. I only invested $10 in each of these companies. One did pretty well and the other 2 were total garbage. You know, but I was able to learn without losing a ton of money or risking a whole bunch of my long-term gains. You want to make your #1 goal to not lose money. And this is even more important than making money. Over the long term, as long as you're buying good quality companies, stocks are going to go up. But if you start buying a bunch of crappy companies, your prices are going to go down and you're going to lose a lot of money. And like I said earlier, when you lose money, you have to double your returns to make up for the lost money. Sometimes it can be a little bit frustrating when you buy a stock and you see it go down for the next week or the next month or the next 6 months. But if you stay the course and stick with it, you will see returns long term. You have to be patient with stocks if you really want to make money with them. When I bought my first share of Amazon in July of 2019, I basically bought at $2,000, which was the peak at the time. The stock price over the next 6 months started going down and I didn't make any money at all, and I was kind of frustrated because I had put a large percentage of my portfolio into Amazon expecting that I would crush the market. I stuck with my belief though that this company would grow faster than the market long term, and after the crash and the rebound between March and May of this year, I'm actually up about 62% on my Amazon shares. Alright guys, I hope you liked the video. If you want to see some examples of how I work through the finances of different companies, check out my valuations playlist on the channel. It might be interesting if you're trying to learn how to do fundamental analysis to pull up these companies' financials and look through them yourself before you watch the video, and then watch it and see what I come up with. See if what you find is the same as what I find. But alright guys, thanks for watching.